welcome back to MMG. Hope everyone had a good New Year's. It's 2020, we're starting a new decade, and it's going to be a wild one, and hopefully a very profitable one as well. I feel great about this new decade. I mean, it's not going to be easy, it's probably going to be wild. But, you know, hopefully everything will work out for us at least, right? Because we are prepared, and it's what we're doing. First of all, not financial advice. Consult your licensed financial advisor. I'm not a licensed financial advisor. I could be completely wrong about whatever I talk about in my own opinions. This is more of an educational channel on trading and listening to me rant and give you guys my opinions about the economy and things going on in this world. So let's talk about some news events going into 2020, and then we'll look at some charts. Gold and silver, they have been performing very, very well for the past week and this week, right? And that's on low volume. A lot of people aren't trading for the holidays. So, we might... That does show you that there's a lot of interest in it, because usually metals don't move during holidays. So that's another sign that possibly the smart money's buying, because they like to buy when nobody else is and no one's paying attention, right? That's what smart money does. Anyways, let's talk about 2020. So yesterday or this week, obviously there's some things going on in the sandbox again, and some of the tweets Trump was sending out, blaming Iran. So, that's been on the list for decades now, like the hit list. So that's going to bring some uncertainty, and we might, well, it all depends. If anything happens, that should trigger a market sell-off, and it will be positive for metals. The repo market, so I'll talk about that in a little bit, but that's going to be an ongoing issue into 2020 and probably for the next few years, or it's not going to go away, all right? Of course, the bubbles, so the real estate bubble that we now have in the US, Australia, Canada, UK, fueled by Chinese, and not just that, it's been reflated, right, since 2008. What else? Elections, that can bring uncertainty. The market does not, it's not even priced in that there's any chance of Trump not getting reelected. So, and I've changed my mind on that, right? But a whole 10 months from now, a lot could happen in the next 10 months. So if the market really does, crash, then things are going to change. I think there'll be a huge correction, but not a total crash. That's my personal opinion as of now. They will keep it up for another 10 months. And Trump will do whatever he can, right? And will he strong arm Powell? Probably, but Powell will probably do it anyways, meaning they will lower interest rates to zero if need be, and then announce QE. But that's coming. That's gonna come anyways. It's just the question of timing, right? Is it gonna come in a few months, or is it gonna happen in the summer or next year, right? Or spring? It's all about timing, guys. The dollar, I think there's some more weakness to coming in for the dollar in the next few weeks and a month or two. Also, you know, Trump doesn't want a strong dollar. Powell doesn't want a strong dollar, and I've said there's a few reasons for that, and that's because, but they don't want too much of a weak dollar either, because it has to be like this dance where they keep the dollar propped up, but they don't want it quite as strong as it is now for trade reasons, and then also fiscal reasons, meaning the interest on the debt is starting to explode. And a weaker currency means that the debt, it shrinks the debt if the value of the currency falls, because all debt is denominated in the fiat currency, and the currency itself is also debt. Um, Another thing, CLOs, right? Collateralized loan obligations for corporate bonds, which I made that video, the next big short. That was what that video was about. So the rating agencies are loosening their regulatory hands around that. So it's just like 2008 and 7 and 9. The mortgage-backed securities, right? It's the same thing. They loosened up regulations on those as well towards the end of the cycle, and then they blew up. So that's another sign, and that's going to probably be a big issue at some point in 2020. As some of these companies, I don't want to say default, but when there's no more buyers of CLOs and junk bonds, then that's pretty much it for them, right? And then they peak out, they top out, and once there's no more buyers, everyone becomes a seller at once, right? And then one after another, a company, starts having major issues. Then you get a Lehman situation where one of them goes bust, and it's like a domino, right? Or the Chingas. You take too many companies' bonds go bad, right? And they can't service their own debt anymore as well, and the interest on it. What happens is, if too many of them start having serious issues, their stocks will fall, and then that's when they go bankrupt, right? And all it takes is a few of those, and then everyone starts looking at all of the other companies' corporate debt, and then everyone wakes up and the light bulbs turn on that everyone's debt is junk, it's really worthless, and then everyone heads for the doors at once, and that's how you have everything, the dominoes start falling, everything blows up. So yeah, you'll get like credit default swaps across, and they always happen quickly and all at once. It just takes one like sort of black swan event, or one company or maybe a couple to start going bad, and like I said, everyone starts looking around and starts researching, and then they realize like most of the corporate debt out there is it's bad. Can't be serviced. It can't be paid off as well. And that has it's worse than the mortgage. It's worse than the housing bubble, right? Because not only is the corporate debt bad, but the share price of the company will drop significantly, and then the company goes under in two ways, right? The corporate debt and their stock shares, which they've been buying back by issuing corporate debt. So they pumped up their own stock shares price with the corporate debt. and then they go bust, and then everyone loses their jobs. And then that's why it's so toxic, and it could be really bad. That's all I gotta say. China. So their economy's really in trouble. Their banking sector and their financial sector has quadrupled in size, and they have more toxic debt than the U.S. and they've been printing like crazy as well. And their banks are going under there, I hear. And they just issued like 400 billion to bail out a bunch of their banks and companies. So China looks worse than the U.S. right now. But so they're in trouble. Europe's really in trouble with their negative yielding rates, right, on bonds, and that's destroying the private sector in Europe. And then we have Brexit. That looks like that's going to go through. So if when Brexit goes through, it's going to shake up the market in Europe, and I don't know if the banking sector in Europe and all their liabilities, everything, could handle it. So that might be a domino to fall in 2020. I don't know. We'll see. But these are just things I'm saying we need to like watch and continue to monitor. Japan also is in trouble. They've been in trouble for decades. They're the biggest counterfeiter out there, and I mean their demographic, everything in Japan, their stagflation, their yen, their currency is really getting devalued right now. So and their banking sector is, but they're all propped up by their central bank as well. And everyone thinks, well, all these central banks will just keep printing and propping everything up. Yeah, but that'll come at the expense of the economy, the real economy on Main Street, and at the expense of their currencies and everyone's savings. So therefore, the economy will still go into a recession if they keep propping everything up, because propping everything up destroys the real economy, because it destroys savings. It keeps companies running that shouldn't even exist anymore. So there isn't real competition or a real market. People's savings get destroyed, so they'll stop shopping eventually, right? So propping everything up includes lower interest rates, and that helps people to take on more and more credit and debt, the private sector, all companies and people, and eventually it just all becomes unserviceable, and maintainable. The interest on all of this is just starting to really accrue and compound, and this is global at this point. And that takes me back to the dollar. So the U.S. Central Bank, right, needs to keep pumping the dollars out, because the entire emerging markets, which is the smaller countries, a good example would be like Argentina, Brazil. So these emerging economies and countries have all this dollar denominated debt, so the demand for the dollar is huge, and there isn't enough. Not that I don't know how they're gonna make it anyways, but to service all their debt. But so the dollar, if it has to weaken to keep the whole global economy spinning. So that's another reason why the dollar is probably going to weaken in 2020. Now, I know the dollar milkshake theory thing, but it's something we have to monitor. So we could see weakness in 2020, things get really ugly, then all of a sudden there's demand for dollars because of safe haven, and when emerging markets start defaulting, then those dollars or the debt disappears, and then there's even less supply of dollars. We'll see. We're just going to monitor this, all right? So very short term, more dollar weakness. Maybe things get really bad, then dollar strength, and then the Fed does crazy things to keep everything from falling apart. Then we see stagflation, and then the dollar really gets hit hard. I mean, don't quote me on the timing exactly. That's why we have to keep monitoring this, and I keep watching. Um, what else? So the housing market, at least in the U.S. Well, in the U.S., I'll talk about U.S. and then I'll talk about the rest of the world. I think that's pretty much peaked out. Listen, um, boomers don't need huge homes anymore. They're cutting back on spending, and having a huge home that costs money to maintain. So they're probably putting their homes on the market, and I feel like Gen Xers, for the most of them, have already purchased their first home. But the millennials are supposed to be the ones, entering the housing market. But they're all just tied down and coupled with student loan debt. So, and the economy isn't that strong, all right? They don't have the same, I would say, opportunities as previous generations. And, a lot of them are, you know. But, yeah, so they're coupled down with all this debt. Uh, I just talked about in my last video all of their credit debt, credit cards, this and that, and their home, uh, not their home, but their vehicle debt. Well, they're not, I don't think, I think they're priced out of the market. Not just that, the homes are still very, very overpriced in the US at least. So I don't think they're going to be buying. So home prices are going to have to start falling. Also, a lot of people this past year tried to refinance their mortgages, but they're refinancing at higher rates now because the Fed raised interest rates last year, right? And but they're doing it anyways. And why is that? Well, why would you refinance to a higher interest rate? It's because you need the money. It's not because it's a good business decision, right? So the only reason you would do that is because you need it. I don't know, to buy a new car or to finance, to pay off credit card bills, what have you. But it means that people don't have savings, which I also covered. I talked about that in my last two videos, how low the savings rate is. So that's just another sign that that's peaked out. The auto loan bubble. I was watching another video. They were talking about how like 90% or something of new loans for vehicles, uh, the borrowers weren't even they didn't run like a background on them to see if they were actually making the amount of money that they claimed they were making on their applications. Like they weren't checked, and most people are getting like something crazy, like 7-year loans on new vehicles, and a lot of people are refinancing from older cars that they haven't even paid off, and then the debt's being put on the new loan on top of the new loan for the newer vehicle. But they can't buy a used vehicle because you have to pay cash for that because you won't get financed for a used vehicle like you will for a new one. I think in the US it's something like 10 to 8,000. Like the vehicle has to be worth more than like 8 or 10,000 to be able to finance it. Like they won't finance anyone underneath that price. So what else? Let's take a look at here's the newsroom. Before I go into this, so the 15% off is gone, but if metals prices keep running for the next few weeks or months, product pays for itself. So everyone who's signed up so far, product has paid for itself, right? Because not all of them, but a lot of them are up. The stocks, they're up by a decent amount. I mean, it all depends on when you joined, right? If it was the beginning of the year, you're looking really good. If it's not too long ago, a few months ago. I mean, you're looking good as well, but not as good. So the sooner the better, right? So go to my website. Just type in MMGinvest.com. What am I looking at? This is me after this past decade. It's hilarious. It's Ben Affleck. This video I posted in the newsroom, it's pretty good. It's short, it's only 11 minutes long, but really good. You should watch that. Impossible Burger raises your estrogen levels. Like all this plant-based stuff, I don't want to get into it, but listen, in the West, like, testosterone's fallen over 30% on average for men. And the less testosterone you have, less likely you're gonna, I don't know, stand up for your freedom, stuff like that, right? I remember in basic training, right? I was in the military. They used to put stuff in the eggs, so you wouldn't, you know, I don't want to talk about it, but I didn't eat the eggs, but so there's less aggression. Let's just say, and another reason, but and you know, I'm just saying. Okay, here's what's crazy. The S&P 500 rallies 29 or 30% now in a year for best annual gain since 2013. S&P 500 adds record 5.9 trillion in value in 2019. Guys, let's round it up because it did go up a little bit. 6 trillion. That's larger than 95% of the world's economies. It really is. It's insane amount of money. Just in 1 year that went into the market. In the US S&P 500, that's just S&P 500. It's not the Dow and the Nasdaq. It's just S&P 500. So in 6 trillion with a T is what? I mean, about it's not quite 1/4. It's like 1/5 the size of the U.S. economy, just in the S&P 500. The Nasdaq 100 surges 38% in 2019 for the best gain in a decade. So if this isn't indicative of near top, I don't know what is. Also, the FANG index, Facebook, Amazon, Netflix, Google, that index is worth more than the entire than Germany's stock market, entire stock market. So, my theory that I've been talking about for the past 2 years that capital is flying into the U.S. markets, I'm pretty sure that's played out now, and that has been happening from emerging markets, from China, from Europe, all of it just flying into the U.S. stock market. So where's it gonna go after this? It's going to go on the gold and silver, and we're going to be so rich. We're not going to know what to do with ourselves. I'm just saying, I'm joking, but not all of it could do that, right? But I'm saying just 5% would make me very, very, very happy if that happens, and just 5% goes into the mining stocks. All right. In the last decade, the U.S. added nearly 11 trillion debt, while growing GDP by only 7 trillion. In other words, every $1 in growth came with over $1.50 in additional debt. So that's why money creation doesn't actually spur economic growth. I mean, it does, but it comes at a higher cost. It's not cost efficient at all, right? So if you're a company and you take on debt, and you do this, you go bankrupt real quick. This is funny, but you guys go in the newsroom or go to any one of my social media accounts and look at this. This is hilarious. Just the This is how politicians think, guys. Um, just check it out. The links are below this video. Alright, so the repo market. Year-end repo crisis ends with a whimper amid massive liquidity glut. So it was supposed to usher in market zero hedge again. It was supposed to usher in a market crisis that would prompt the Fed to launch QE4, according to repo guru Zoltan Pozar, in the end of the preemptive liquidity tsunami unleashed by the Fed in mid-December, which backstopped just shy of $500 billion in liquidity, proved enough to keep any latent repo market crisis at bay. So basically, $500 billion, half a trillion, they just made out of thin air and pumped it into the banks, and they're just rotating that money. As soon as it comes due, they just issue it back the next day. And they papered over the problem. I guess they papered over it so much that nothing's happened. So that hasn't come true. The year's final overnight repo operation, which the Fed expanded to as much as $150 billion, ended up being just 17% subscribed, as dealers submitted only $25 billion. So banks weren't taking the full amount that they were issuing the Fed. They don't have to take it, right? So a sign would have been that they take 100% of it, meaning they need it. But if they don't, that means they don't. But who knows what really goes on behind the scenes? You never know. It's not audited, the Fed, right? So, anyways, or this could just all be for show for now. And then all of a sudden, like a few days from now or a week from now, they're just taking all of it, and the repo keeps increasing. And so does the Fed's balance sheet. I mean, this is ongoing, guys. So it's not going to, for a month, it might look good. Another month later, it gets worse, right? So, but this is pretty crazy. The market will have to react if the balance sheet hits new all-time highs. I mean, we're not there, but at the pace we're going, by the end of 2020, we could easily be over 4.5. On their balance sheet, right? So Fed or repo operations total cash actually in the market. So it's been falling recently for the past few days. So let's just take a look at some stuff here. So we've been in Afghan for 20 years almost, or we have. Decade in tech. This is crazy. I haven't read this. I'll post this in the newsroom. Or you guys can look at it. Or look it up. Just go to Zero Hash. China colonizing Africa. I knew they put roads throughout the entire continent. And they've been building companies and just loading up and paying off literally entire countries there, and giving them tons of loans, right? And later they'll just raise the interest rate on it and then like take over. But are they actually going in there? Like, that's not good for Africans. I mean, just look at what they're doing to certain people in their own country in China, right? Just harvesting body parts and selling it while they're alive, by the way. And they have like, I think somewhere around 1 million in camps, in educational places, right? So population growth is at its lowest in the U.S. And one of the large economic arguments is if the population decreases, it's so will GDP, so will growth. Yeah, in a way, but if the country doesn't have a lot of debt, it's not really a big issue. It's only an issue when for revenue for the government, right? It's great because they want more and more people to pay more and more in taxes, right? So Also, yeah, but the problem is the U.S. is turning into Japan, right? Just a huge elderly population, larger than, well, the baby boomers aren't larger, but they're huge, and we're just turning out to be Japan. Stagflation with an aging demographic, right? Which means like no growth for decades. On top of the industrial section gone and just so much debt entitlements that it's insane. And millennials are pretty much socialists, which is really, really bad going into the next decade here. I don't see that trend stopping. Uh, and it, and more of them are voting, right? Millennials. So whoever, it doesn't look good. That just doesn't. I don't want to be, negative, but it is what it is. Yeah, they need 400 billion liquidity hole. So the super rich, they're actually losing money on their, classic cars, diamonds, and wine collections, and all, and art, like bananas taped to the wall. Um, and that's indicative of the end of a bull cycle. Although they buy these things, do you want to know why they buy these things? Because you could transport them from across country, right? Across the world, and then sell them somewhere else for cash. That's the real reason. Like I said, I mean, Trump's tweeting about this, and the war drums are beating. Who knows if it'll actually happen? By the way, Iran's like backed by Russia and China, so um, that could turn out to be something bigger than what we've seen in the past decade, right? And I don't think Americans want this. I don't think anyone does, and it's really not good. It's very bad for the U.S. I mean, we can't afford another war. I mean, that's just how it is. Although a new spending bill was just passed, right? Like this past month, 1.4 trillion, and like half of it or a lot of it went to the military. So there's probably a good reason for that, right? But I was thinking that it's more for China, right? Because China's becoming a serious threat and new global superpower, possibly. So, what else? Let's take a look at this Jim Bianco article. 'Cause he usually knows what he's talking about. Yeah, it's the balance sheet. He's basically saying this is QE4. Oh, yeah, I forgot this article. So, I forgot which bank. It was a big bank, one of the big top like 5 or 10 in the world. They basically just came out and said, yeah, the Fed's doing QE. So when a major bank is saying it, uh, but the market knows that. That's why it's been going up. So I don't think anyone's fooled. I just think that the market's like, yay, free money. Markets will never fall. This time's different. It's going to keep going up. Like Venezuela's stock market. Past year was up 4,000%. It's sad. So the Fed supplied repo to the market during Y2K. Did they really? So what he's saying is this is very similar to the Nasdaq bubble, right? Uh, wow, look at this. Yeah, it's very similar to the Nasdaq bubble. What's going on right now? Except this bubble is like not just some .com bubble. This bubble is like the everything bubble, right? With ever increasing debt, like privately and publicly and fiscally for so yeah, ever since they've been doing repo, the market's just been shooting straight up. Like not, we haven't even had a dip greater than like 4% or 2%, something like that, something crazy like that. Talked about it like a few videos ago. So I'm gonna read into this a little more. I'll post this in the newsroom. This one looks good. So what else did I want to show you guys? So going into 2020, we're looking at deficits or spending over well, the spending's always been the U.S. spending right now. The government rate is 4.5 trillion. The budget deficit is over $1 trillion, which is insane. Year over year here. So this is just bad. Just the interest is almost 400 billion. Just the interest. So at some point, here's the thing. I forgot which podcast I was. Oh no, I was listening to a good book. Once a country goes past 90% debt to GDP, it's like almost impossible to reverse it. Like it just goes bankrupt. And most countries are like that in the world. Not most, but a lot of them, right? A lot of the large countries. So they don't have, well, public. Wow. Japan, look at Japan. It's almost at 250%. But this is only public. You have to add public with external. And that's the real number. Or no, it's not. They don't have debt to GDP up here. Well, you would subtract gross domestic, or you would subtract this GDP from the national debt, and then you get or no. All right, this is why you don't do math when you're making videos. All right, it doesn't matter. But I just want to look at that. So going into 2020, we're going to see, because you have to understand that the debt is starting to just go parabolic because there's interest on it and it's all compounding. So by the end of 2020, I mean, it could look really, really bad where the deficit's like at 1.5, 1.6 trillion. The interest is, who knows, 600 billion. Or I mean, that's insane. So, and the markets and the economy just can't ignore it. I mean, they keep ignoring it, but at some point they can't. Also, I mean, Trump's a big spender, and the only way he could pass anything is if he compromises because of the way things are right now with Congress and all that. So, he has to compromise, meaning the only way he gets what he wants is if he gives what the lefties want, which is all just more and more spending. There is no fiscal conservative whatsoever, and that's the biggest threat to the economy and everyone, right? So yeah, let's take a look at the charts. I'm done. All right, gold has been shooting up like crazy. VIX looks like it's ready to pop. Dow, S&P, they're still very near all-time highs. I mean, literally there, right? But I'll look at those individually. The dollar's at 96.5. I expect it to at least revisit the 200-week MA at the 95 handle, right? The dollar index. So weaker dollar for the short term. Why can't I see? Where's gold? Well, here's the 10-year yield. I expect it to they're gonna cap it, right? They're not gonna let it go much higher. They can't because of the surmounting debt. So if it goes any higher, it might uh, prick the bubble, right? So they have to keep yields lower. The lower the 10-year yield goes, the more positive for gold. Let's take a look at the Russell. The Russell looks like it's ready to correct. And I know I've been waiting for this for weeks, guys, but they're holding it up for the end of the year. Well, basically, no one wants to take profits because they don't want to pay capital gains, right? So today the market's closed, the first. Tomorrow the market opens. Maybe everyone wants to start taking profits. But look at the Russell. This is a weekly chart, by the way. It's extremely overvalued here, or overextended and valued, but it's overextended, and I expect it. I'm gonna move this arrow to correct. It needs a pullback, a significant one, something of a decent size. Here's NASDAQ. NASDAQ looks ready. The heat map's telling me it's ready. We have this week's candle is a 2 count. If the 2 can't surpass the 1 count on the TDI, then we could see a 1 to 4 or even 9 candle pullback, right? It's also extremely overextended, looking at the oscillators and the MACD, RSI, all that. And this is a weekly chart again, NASDAQ. Here's the banking stocks, or indexes, or ETFs, sorry. Extremely overextended. I mean, look at this. This is nuts. So this is World Bank financials. This is the S&P 500 financials, and this is the U.S. financials. I mean, look at this rally. So this can't be sustained. I mean, if it goes any higher, it's going parabolic, like straight up 90 degrees. And yeah, I'm not using a logarithmic chart. It's easier to see the price action this way. So they're overdue. Just looking at it, I mean, it's not that difficult. TA wise, they look ready to pull back or correct. Here's crude. Oil's at 61. It broke above 60. I think oil is gonna go up a little higher. Might test around 71 in the next few weeks, or next month or two, which is not good for the economy, right? Because higher oil prices mean less traveling and less shopping, because you're spending more money on gas rather than buying things you don't need or want. Fangs. Last week was a 9 count. In this week, they sold off not significantly, but it was a nice sell-off this week. So, and look at the RSI. This is crazy. Momentum oscillator, all of them. TM squeeze, MACD, all overextended. So, it's overdue. It's ready for a correction. The Fangs, and if the Fangs correct, it's gonna take the rest of the indices, S&P, all of them. So here's the Dow, or no, this is the Dow Transports. Not much to look at, but it should probably retest this channel. Well, it's not really a channel, but it doesn't matter. All right, natural gas. I mean, this looks horrendous. If it doesn't bounce here and retest the top of this triangle, I mean, natural gas, those companies might, they're probably in deep trouble. I mean, they're all over leveraged with debt as well, because there was a huge, bubble and boom in natural gas in the past 10 years, since 2009, 2008. That's when the, excitement really started with natural gas and shale fracking. All right, so let's take a look at gold now. So the daily's on a 9 sell for gold here. Let's take a look at the weekly. Gold's on the left. Or let me... You guys can't see it. Hold on. There we go. Look at this rally. Did I not call this? I called this perfectly. So there's a lot of bullish scenarios for gold for the next few weeks. One, the seasonality. It's always stronger around the beginning of the year. The sandbox. Things are getting hot there again. Repo. You never know. The repo madness stuff. The market, if it corrects in a really big way, like we see a huge drop that happens quickly, like within a 2-week span, 3-week span, like let's say over 10%, 15%, people start getting real nervous. And then and the smart money starts pricing in rate cuts and QE, and gold's going to rally, like in a really big way, like another whole leg up. Maybe it'll get past that 1680 resistance and go higher, and maybe test all-time highs of 2011. And at that point, guys, these mining stocks, they're going to explode in price. They haven't exploded yet. There's been a few small ones here and there, right, that are up like hundreds of percent. But we haven't seen the fireworks in the metal stocks yet. Yeah, so the dollar weakening for the short term at least, 95 handle, that's going to help metals. And the world, Europe, Japan, China, they're definitely easing as well still. Capping of yields, and yeah, maybe people will start looking at the debt. Probably not yet though. I think the market is going to start getting concerned about the debt during or after a stock market, like, I don't want to say crash, but real huge correction. Like, we're in a recession, right? That's when the debt, people are going to start freaking out about the debt and coming back to reality. And, that's when metals could go into a bubble. What would a bubble look like for metals? I mean, if gold goes above 5,000 or even 7, I think 7 would be properly 7,000 per ounce would be properly valued and then maybe 150 or maybe 300 for silver an ounce. These are my theories. I'm not saying that this is exactly what's going to happen. I don't really know, but I feel like those would be the proper value for these monetary metals, considering everything that's happening in the world today. So and the amount of debt and everything. So what would a bubble look like? It'd be higher than those prices. I'm not saying that's going to happen. I don't really know. I would just be happy in the next 3 years we see 3,000 gold. I'm already happy then. All right. Where was I? Oh yeah, weekly chart. Well, MACD is about to cross to the upside on the weekly. It hasn't even crossed. Had a bullish divergence here. Momentum's neutral. It hasn't even crossed to the upside yet. So it's not overextended on the weekly. And it's on a 5 count, meaning 5, 6, 7, 8, 9, 3 to 4 more weeks of upside, according to the TDI indicator at least. And we broke above 1,500, which is also very, very bullish. Matter of fact, in the past few days, we hit 1,530. So I think we're gonna go higher. Can we get a short-term pullback next few weeks or next week? Yeah, sure. Retest 1,500. Yeah, sure, but I don't think so. I think we're gonna just keep going higher here. Let's take a look at the 3-day chart for gold. It's on a 7 count, so 8, 9. One more week of upside according to 3-day. And then the daily again is it's on a 9 sell, so we could actually technically sell off soon. tomorrow maybe. 1 to 4 day pullback. I don't know. We'll see. They might smash it on the open and then retest 1500 and then higher. That's what I'm hoping for. So also another thing. What's this? Here's the gold to silver ratio. So these green vertical lines are when a bull market started in metals. You can see back here in 2003, 2002. This is when a bull market started in metals, and the NASDAQ bubble popped back then, right? So the beginning, whenever metals go into a bull market, the silver to gold ratio is at its highest. It's around 80, right? Another one here was back in 2007 and 8. The gold silver ratio hit 80 again. And that's kicked off another bull market cycle all the way into 2011. This red vertical line means the metals are ready to correct and go into a bear market. And you can see that ratio closed, meaning it was 31, 32. What does that mean? 32 ounces of silver would get you 1 ounce of gold. But at the beginning of the bull market, it's always like 80 ounces of silver would get you 1 ounce of gold. That's why buying silver is like super leveraging. It's like you get way more upside. Now, imagine if you bought silver mining stocks. Like one of my silver mining ETFs like rocketed in the past week. So it was a good pick. It was a good find. Currently, we're at 85 silver to gold ratio. So it's not too late, right? Take advantage of this. And yeah. I'm going to add a few more silver mining companies in the private group that I'm looking at. What else? Here's the ETFs. And these are just ETFs. They're not... So mining ETFs, right? Baskets of mining stocks. It's not a futures derivative, or it's not a futures... It doesn't track the futures. It tracks... These are baskets of mining stocks, right? They're doing great. They've rallied in the past 4 or 5 days, 6 days, significantly. All right, I think that's pretty much it for now. I'll make a separate video talking about BTC. Am I missing anything? I feel like I'm missing something. I don't know, probably. Well, smash some likes. Leave anything in the comment section. Let me know in the comment section if you want me to cover something, and share my videos. It helps me out a lot. Go to my website and go to the free chat groups. There's free ones where there's a lot of people. They share information and talk about all kinds of things. And yeah, till next time, guys.